Is the 2025 crypto bull run cancelled? Is the crypto cycle set to end in the next 3 months? If you know crypto at all, you would have heard about the 4-year cycle. Since the beginning, Bitcoin and crypto has run on a fairly predictable 4-year cycle consisting of a crypto winter, spring, summer, and fall. The usual pattern is crypto peaks roughly 18 months after the Bitcoin halving, which would suggest that our current crypto cycle is going to peak at some point in the next 3 months, either now in October, November, or December this year. But what if this time is different? Macroeconomic expert Raoul Pal believes that this cycle isn't set to end in 2025 at all. His new prediction is that our current setup points to a cycle extension into 2026, where the bigger liquidity wave hits. Raoul is saying that everyone has it wrong and the real peak is coming later than everyone expects. In this video, we're going to break down all the signs that suggest a crypto peak is coming, not in the next 3 months, but that this cycle will go deep into 2026. Stay with me, because the setup into the next leg is forming today. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's begin and hear it straight from Raoul Pal first.
Why is Bitcoin sort of not wildly off to the races yet? And it's this chart. Bitcoin is basically, this is a detrended Bitcoin, and it's basically the ISM, which is the business cycle. Remember, we've always said it's the business cycle stupid. It is always the business cycle stupid. And all of these people who claim it's the 4-year cycle based around this and that, they don't understand the fundamental of what the business cycle is, why there's a 4-year cycle in everything. And we've explained it, and we'll go through it in great detail tomorrow in our Everything Code presentation. But basically, it's following the ISM. And rates have been following the same pattern. You see, rates should have come lower. They need to come lower because we need to roll the debt. We've talked about this. That's part of the Everything Code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement. Earnings versus scarce assets. This is the issue that they need to solve, and they need to get rates lower. They get rates lower. Why? Why do we have an elongated business cycle that looks like virtually no other time? It's because, and I only just found this out redoing the work on the Everything Code recently, is that in 2021-22, they actually extended the maturity of the debt from 4 years to 5 years. So that extension of the maturity of debt has pushed out the business cycle a year. The 4-year cycle this time around is a 5-year cycle. We don't know what the next one will be until we see where they all end up getting refinanced. Whether it comes back to 4 because they managed to get some stuff at the long end, or whether they shorten it because everything's in the short end. We don't know yet. But this one is a 5-year cycle. And this is what it looks like. A 5.4-year sine curve. 5.4 years is the exact average weighted maturity of the debt. And it tells us the ISM should peak by 2026. We think liquidity probably peaks before that, as the rate of change of ISM changes and the rate of change of liquidity changes. Our best guess remains well into 2026, probably Q2.
For years, crypto investors have lived and breathed the idea of a 4-year cycle. Halving comes, price rallies, a parabolic top forms, then comes the crash. It's neat, it's simple, and for a long time it felt like a law of nature. But Raoul Pal argues that 2025 will not be the grand finale people are expecting. The reason is buried deep in the business cycle itself. Instead of Bitcoin simply moving in halving-based waves, it has been tracking the global economy almost one-to-one, specifically the ISM Manufacturing Index. This index measures expansion and contraction in the economy, and history shows that whenever ISM is in contraction, crypto tends to bottom and quietly accumulate strength. Whenever ISM rises toward expansion, Bitcoin starts climbing with it. Here's the problem for those expecting fireworks in 2025. The ISM is not yet in a full expansion phase and rates are still elevated. That means liquidity, which is the real fuel of risk assets, has not reached its peak. According to Powell, the debt structure of the United States literally pushed the business cycle out by a year when Treasury maturities were extended during 2021 and 2022. Instead of the typical 4-year cycle we've all come to expect, this one stretched to 5 years. The result is simple but profound. The so-called 2025 bull run will not end in 2025. The liquidity and growth peak are not due until 2026, and the crypto market is just mirroring that reality. This turns the familiar narrative upside down. If you were preparing to dump your Bitcoin in late 2025 out of fear of another catastrophic collapse, Pal's data suggests you'd be selling a year too early. The elongated cycle means 2026 is more likely to be the true peak, with liquidity conditions aligning perfectly to drive capital into scarce assets like Bitcoin and Ethereum. And while some investors may be disappointed that 2025 won't see the euphoric blow-off top they imagined, the bullish truth is that this gives everyone more time to accumulate and prepare. Instead of a race against time, we're being handed a longer runway. To understand why this cycle is stretched, you have to look at the structure of the US debt market. In 2021 and 2022, the Treasury shifted much of its borrowing from short-term maturities into longer-term 5-year maturities. On paper, this looked like smart management, lock in low rates for longer. But what it actually did was extend the timeline for when that debt would roll over, effectively pushing the entire business cycle forward. The average weighted maturity of US debt became 5.4 years, which perfectly matches the sine wave Pal uses to track the ISM. In other words, the heartbeat of the economy literally slowed down and Bitcoin is moving in rhythm with it. Now, why does this matter for crypto? Because Bitcoin is no longer a fringe asset detached from the global system. It has matured into a macro asset, one that trades in sync with liquidity and credit cycles. When rates are high, liquidity is tight, and capital prefers short-term instruments like money market funds. But as rates fall, something that will be forced to happen to manage the rollover of massive government debt, liquidity floods back into the system. Risk assets, especially those with scarcity built in, benefit most. That's Bitcoin's setup heading into 2026. And here's where it gets even more bullish. If the Federal Reserve does cut rates to ease the rollover burden, we're not just talking about a minor shift. We're talking about trillions of dollars in global liquidity being unleashed, the kind of flood that historically sends Bitcoin multiples higher in a matter of months. Investors have been conditioned to believe the 2025 halving will deliver a repeat of 2017 or 2021, but the true driver this time is macro. With debt maturities dictating policy and ISM signaling that the peak is delayed, the crypto cycle aligns perfectly with a 2026 liquidity crescendo. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Let's continue. The crypto market has matured into something most early investors never imagined. It's no longer a niche playground detached from the real world. Bitcoin and Ethereum now behave like macro assets, moving in sync with the broader business cycle. That's why Raoul Pal focuses so heavily on the ISM, the Institute for Supply Management's Manufacturing Index, because it provides a direct read on whether the economy is expanding or contracting. For context, any number above 50 signals expansion, while anything below 50 points to contraction. Right now, ISM remains below 50, which means the global economy has yet to enter full expansion mode. Why does this matter for crypto? Look at the history. In both 2015 to 2016 and 2019 to 2020, Bitcoin traded sideways and even dipped while ISM lingered under 50. But the moment ISM began to turn upward, crypto ignited. Investors who bought Bitcoin during those contractionary periods when fear was high and growth looked sluggish saw some of the most explosive gains once the economic cycle shifted gears. Pal's point is that we are living in that exact setup again today. Far from being a warning sign, ISM under 50 is a flashing green light for accumulation. This perspective flips the old halving-based narrative on its head. Instead of watching the calendar and assuming a repeat of 2017 or 2021, investors need to watch ISM. When it rises into expansion, Bitcoin historically enters its strongest rallies. And given that the ISM peak is not expected until 2026, the implication is clear. The biggest fireworks are still ahead of us. One of the most bullish indicators during these quiet periods is what happens behind the scenes. When prices aren't mooning and attention drifts away, serious builders and capital allocators get to work. We're already seeing that play out across crypto and AI intersections. Take Bitensa, for example. A new fund launched specifically for TAO and its subnet token signals growing institutional attention toward AI-linked crypto networks. These subnets aren't just speculative plays, they're powering real-world use cases from AI companions with millions of users to infrastructure that rivals the cost of AWS. That kind of development happening while ISM is still below 50 is exactly how the groundwork for the next bull run is laid. The same can be said for partnerships like Sui's collaboration with Google on agentic payments or Swissborg's aggressive buyback program for its Borg token. These moves may seem like side notes during a slow market, but historically it's these quiet accumulation periods that produce the strongest market leaders once liquidity floods back in. Just as Ethereum's dominance in DeFi was cemented during the 2018 to 2019 doldrums, today's builders are setting themselves up for massive relevance in the 2026 cycle peak. When you zoom out, it becomes obvious why Raoul Pal emphasizes patience. The current environment, marked by subdued ISM readings and slower liquidity flows, is not the end of the bull market, it's the staging ground. Institutions are allocating quietly, projects are shipping, and capital is positioning itself for the next expansionary surge. If history repeats, those who lose conviction during this stage will be the ones watching from the sidelines when Bitcoin goes vertical. And when we connect this to the broader debt and liquidity dynamics, the full picture of why 2026 is set to be historic comes into focus. If the ISM is the heartbeat of the cycle, the US Treasury market is the bloodstream. Right now, America is carrying more than $37 trillion in debt, and rolling that debt over is becoming the central challenge for policymakers. The maturities extended in 2021 to 2022 bought time, but that time is running out. Trillions of dollars are set to roll in the next 2 years, and the government cannot service them at current interest rates without crippling itself. Something has to give, and according to Raoul Pal, what gives is rates. The Federal Reserve may talk tough about inflation, but the reality is that high rates are unsustainable in the face of this much debt. To roll it over, the Fed will be forced to cut rates and inject liquidity back into the system. And when that happens, risk assets are first in line to benefit. Stocks will rally, yes, but the asymmetric upside is in Bitcoin and crypto. Unlike equities, which are already sitting near all-time highs, crypto is still lagging behind its potential. It's the perfect setup: suppress prices during the contractionary phase, followed by a flood of liquidity as debt forces the Fed's hand. Pal points out that this is why the cycle is extended. The rollover schedule of US debt literally shifted the timeline of when liquidity can peak. Instead of 2025, that wall of money is likely to crest in 2026, and for crypto investors, that's the moment of truth. Far from being cancelled, the bull run has simply been delayed by structural forces that most market participants aren't even looking at. At first glance, the idea of waiting until 2026 for a peak might feel frustrating, but in reality, it's one of the most bullish developments imaginable. Every extra month before the peak allows for greater adoption, deeper institutional integration, and more infrastructure to be built. Spot Bitcoin ETFs in the US have already opened the floodgates for traditional capital, but that's just the beginning. Pension funds, sovereign wealth funds, and corporations are still in the early stages of considering allocations. With another year added to the cycle, their entry points are multiplied. Meanwhile, Ethereum and the broader crypto ecosystem are expanding their dominance in tokenization, AI integration, and decentralized finance. BlackRock is actively piloting tokenized funds. Global banks are experimenting with blockchain-based settlement systems. The longer the runway, the greater the chance these initiatives scale before the market truly peaks. That means when liquidity finally collides with adoption, the upside won't just mirror 2017 or 2021, it could exceed them. And don't forget the psychological edge. Many retail investors are locked into the old 4-year template. They're preparing to sell in 2025, bracing for another brutal collapse. But if Pal is right, selling in 2025 would mean cashing out just before the true expansion wave. In a market driven as much by psychology as by liquidity, being on the right side of that miscalculation could be life-changing. This isn't about catching a standard cycle. It's about positioning for a supercharged extension. And as we look ahead, the final key is patience will be rewarded, and those who understand the extended timeline will be the ones holding strong when the final wave hits. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.